Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Fall Webinar Series. This program is entitled Timely Wealth Planning Strategies for Year-End, Midterm Elections, and a Recessionary Environment. For those who don't know me, my name is Jonathan Shenkman. I'm the president of Shenkman Wealth Management. In that role, I work as the financial advisor, portfolio manager, and serve as a fiduciary capacity for my clients to help them achieve their financial objectives. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Okay, with that introduction, let's jump into the program. This works. Let's go. So many of my programs offer a deep dive into specific topics. This program will differ in that we'll aim to cover a variety of timely ideas. Hopefully, by the end of this webinar, every attendee, whether you're a practitioner or an investor, will be able to walk away with at least one or two ideas that you can implement for yourself or your clients. Today, I'll cover the following areas: an overview of the economic investment landscape, and I'll try to offer some big picture perspective amid all the noise. I'll discuss some recession and financial planning ideas. We'll then move to some strategies to mitigate the impact of inflation. I'll offer some practical thoughts and perspective on the midterm elections. And finally, I'll share some year-end planning opportunities. First, I'd like to just paint a picture of the economic and market backdrop. As of this program, the US stock market is down about 22%. The investment grade bond market is down about 15%, and inflation is at a 4-decade high at around 8%. Despite this challenging environment, there has been quite a bit of debate on whether we're actually in a recession or if we will enter one soon. Technically, economists at the National Bureau of Economic Research, or NBER, define a recession as an economic contraction starting at the peak of the expansion that preceded it and ending at the low point of the downturn. In this calculation, they consider things like non-farm payroll, industrial production, and retail sales, among other indicators, to try to pinpoint the start and end of a recession. According to the NBER, a downturn must be, quote, deep, pervasive, and lasting to qualify as a recession, unquote. The reality, these are retrospective judgment calls made by academics, and practically, they're not helpful to the average investor. Whenever I hear a politician, economist, or a market prognosticator debate whether or not we've actually entered a recession, the only thing I can think of is, who cares about the technical definition? Americans are already struggling with non-discretionary expenses like gas and food spiking in price. That in and of itself is devastating to many families. As we all know, the Fed is raising rates rapidly in an attempt to tame inflation. Unfortunately, the byproduct of this strategy is an economic slowdown, a loss of jobs, and higher borrowing costs for Americans looking to build their business or buy a home. The situation is even more dire for those who are in retirement or approaching retirement. People who are no longer receiving a paycheck must start withdrawing on their funds as the market is in a downward spiral. This may lead to their nest egg lasting for much shorter than initially planned and can leave them in a financially devastating position. But this program is not about focusing on the negative. There's enough negativity by just turning on the news or reading the paper every morning. Instead, let's spend the remainder of this program turning lemons into lemonade by making the best of these challenging times. I'd like to start by offering some ideas on how to mitigate the impact of a recessionary environment. The key is analyzing two specific areas: lifestyle adjustments and portfolio modifications. First, lifestyle adjustments. Investors are quick to go straight to their portfolios for solutions to mitigate a turbulent market. In reality, many of the best strategies are outside of your portfolio. And I apologize to all the sophisticated attorneys, CPAs, and financial advisors on this call. Lifestyle adjustments are far less sexy than discussing investment or tax planning opportunities, but modifying one's lifestyle is oftentimes the most effective approach. One example is to work longer. While this is undoubtedly an unattractive option for folks who want to retire, it may be the best solution to ensure their retirement is on track. Simply continuing to receive a paycheck allows someone to save more and delay withdrawing from their funds during a downturn. A related suggestion is to work part-time. Sticking it out in a full-time job may not be necessary. It may be possible to ease into retirement while working a few days a week, whether in your current industry or something different. A small income from part-time work may be enough to minimize the extent you withdraw from your portfolio in a down market. Another option is to tighten your belt by lowering your discretionary expenses. Pre-retirees may have had grand plans for their retirement. However, if the market is down and they no longer want to continue working, they should probably reevaluate their initial retirement plans. In some situations, small modifications can have a large impact. This might mean traveling less, picking less expensive hobbies, or not going to eat as often as you initially planned until the economy gets back on track and your portfolio bounces back. Now let's discuss some practical portfolio modifications. While a buy and hold strategy is generally advisable during extreme circumstances, taking a more proactive approach towards your money, is the way your money is managed, may help brace you for this challenging environment. One thing I advise all my clients who are approaching retirement or folks who are early on in the retirement years is to maintain more cash for an emergency. Developing a more substantial cash cushion may help keep investors at ease as the market is falling. There is a comfort in knowing that in case of an emergency, an extra safety net exists to allow you to avoid liquidating funds as prices drop. This also mitigates sequence of returns risk, which is experiencing a series of bad returns as you would start withdrawing on your portfolio. Retiring in a down market like 2000, 2008, or now in 22, and selling investments at depressed prices can cause someone to run out of money sooner than expected. It's also worth noting that one of the positives for savers in this environment is money market rates have gone up significantly from earlier in the year. So even though you have more money sitting in cash, at least you're earning some interest. Another similar option is to utilize a bond tent. This is the concept of keeping a few years worth of funds in high quality bonds to pay for living expenses if necessary. It is a slightly more aggressive approach than sitting in cash, since bonds can fluctuate in value while cash will not. The risk to bonds is evident today with investment grade bond market plunging, as I mentioned earlier. If your risk tolerance allows you to move some of your safe money into high quality bonds, this will get you a bit more yield on your investments given the rise in interest rates. Another strategy is to reevaluate your asset allocation. It's only after your portfolio drops meaningfully in value that some investors realize they have no real investment game plan in place. For many years, it was possible for novice investors to cover up their poor decisions since the overall market appreciated in value. Now is a great time to reassess your asset allocation and risk tolerance to determine if you need a more disciplined strategy to manage your funds. In a sense, going through a tough market can serve as a wake-up call to clean up your finances. Now let's turn to some perspective on inflation. Here's a good framework to think about this historic spike. If you have 10 plus years until you need your funds, which is a relatively long time horizon, and have a job, then inflation should not keep you up at night. There are three reasons why. First, income growth. You still have a paycheck that should rise as the cost of living increases. This is a natural hedge against inflation. An aggressive portfolio. If you have a long time horizon, you may be more heavily invested in stocks rather than bonds or cash. Historically, the stock market's long-term returns have outpaced inflation. And finally, you have time. I find the phrase, "this too shall pass," to be very relevant. Markets move in cycles. While this inflationary environment is challenging for many investors, eventually it will pass. If you have a long time frame, then inflation is not a permanent problem for you. In time, it will come under control. Now, if you're rapidly approaching retirement or in the early stages of retirement, inflation becomes a bigger concern. You may no longer have a paycheck and can't take as much risk with your portfolio, and don't necessarily have the luxury of waiting out a long inflationary cycle. That being said, there are still some tools to mitigate your risks. The first two items are strategies that will also help with a recessionary environment, which I've already mentioned, and those are to either work longer or work part-time. Working another year or 18 months longer than planned until this inflationary cycle passes may be the silver bullet to all your inflationary concerns. Another strategy is to delay claiming Social Security. If you have yet to claim Social Security benefits, then holding off may be a sensible approach to help offset the impact of inflation. Today, full retirement age for a retiree to get their full benefit is 66. One can claim Social Security as early as age 62, but anything before full retirement age comes with a reduction in benefits up to 30%. However, Social Security will add an additional 8% delayed retirement credit to your monthly payout for each year up until age 70. You hold off on claiming the benefits. That's an annual return of 8% for deferral after your full retirement age. Social Security has the added benefit of a cost of living adjustment or COLA. While the COLA increases usually are not enough to keep up with actual inflation, there are not many other forms of guaranteed income in retirement planning that also adjust for the increasing cost of living. It's important to take a step back also and not panic too soon about inflation. You may have a high enough asset level where it shouldn't be concerned. Granted, you may need to spend more money than you initially intended because prices went up. But if your nest egg is sufficient, this will have no material impact on your finances or lifestyle, and worrying about inflation is not necessary. There are also investments that are now attractive for very conservative investors who are in retirement. These include I bonds, which are currently paying over 9% and can be purchased through the Treasury website. You can only put in $10,000 per Social Security number with some exceptions. So this is not a particularly attractive solution if you have a large portfolio. The rate is also going down to about 6.5% next month, which is still attractive but meaningfully lower. It's important to note that if you are early in retirement, bonds should probably not make up the lion's share of your portfolio anyway. You'll need to outpace inflation over the long term, and equities are really the only sure way to do that. One final point I'll leave you with on this topic, which is to keep in mind that inflation impacts everybody in different ways. Naturally, if you commute a long distance to work every day, then the rising price of gas is going to hit your wallet. If you're in the market for a new car this year, then you will likely pay significantly more than in previous years. However, if you work from home and don't have any major financial outlays, then inflation may be less impactful. The key is to focus on your own personal inflation situation and work out a strategy to plan for it. Just like with most other aspects of life, with proper planning, you should be okay. Now let's move to everybody's favorite topic, politics. Or should I say everybody's favorite topic to get super emotional and make imprudent investment decisions about. Without fail, during every election cycle, friends or acquaintances tell me the drastic decisions they plan to make if their desired political party is not victorious. Some tell me that they're going to move their entire portfolio to cash, or going to go all in one specific sector of the market. One person even told me that he'll pick up and move himself and most of his assets out of the country if his desired candidate didn't win. He actually followed through on that threat. Over the next few weeks, every major investment firm will come out with their investment guidance based on the midterm elections. Keep in mind that these are not research reports or white papers. I spent over 15 years on Wall Street, and I could say definitively that these are marketing pieces. They're interesting to read and discuss with friends, but they should not trigger any major changes within your portfolio. Before the 2020 presidential election, I gave a 30-minute webinar exploring historical numbers when it came to elections. I'm going to skip that analysis and just give you the 2-minute overview. Historically, the year after a midterm election, the market tends to outperform the midterm years. The S&P 500 has gained since 17 of the last 19 years after the midterms for an average of 16.36%. In 14 of these years, gains were in double-digit percentages. You go back to 1933, markets have experienced 10.4% returns in all years that a single party controlled the White House and both chambers of Congress. This is just below the 10.8% gains in years with a split Congress, a scenario which many people think is a strong possibility this year. Even the least good outcome, when the president's opposing party controls Congress, notched a solid 7.4% average return. While past returns don't guarantee future results, as an investor, I take comfort in this data and firmly believe with the proper process in place, there's a lot to be positive about, irrespective of what happens in Washington. The most important thing to remember about politics investing is not to mix the two. You can do this most effectively by removing emotions from your investment process, by automating as much as you can. This includes dollar cost averaging, rebalancing systematically, and always staying globally diversified. No one knows what asset class will outperform based on who's in office, and having exposure to various areas of the global markets is the best approach. And before I forget, I know some of you are probably wondering why I didn't bring up the Inflation Reduction Act in my inflation slides, but I'll bring it up here because it's more related to politics. I didn't bring it up in regards to inflation because it's a 755-page climate, tax, and healthcare package that does a lot of things, but has nothing to do with lowering inflation. In short, it's going to establish a 15% minimum tax on the mega corporations, boost funding for the IRS, allows Medicare to negotiate prescription drug prices, that offers $260 billion in tax credits for renewable energy projects, and some more. One thing it likely won't do is reduce inflation. Now let's move to our last section, which are strategies to consider before year end. Since we're still in October, there should be plenty of time to take action on many of these items. Let's jump into it. So year-end investment do's and don'ts. The first two items I've already discussed, but are worth emphasizing again. Do evaluate your overall allocation. I already discussed the importance of doing this now in the context of the recession. Year-end is a great time to reassess and make the appropriate adjustments to your investment mix of stocks, bonds, alternative investments, and cash. You should also consider rebalancing your portfolio. Since the market went down significantly, your initial allocation is probably totally out of whack. It may make sense to rebalance your portfolio over the next several months to ensure your allocation is brought back to its appropriate risk tolerance. This is a wonderful opportunity to buy the dip, lock in some losses for tax purposes, and bring back your portfolio to its intended allocation. Do get rid of some investment duds. You shouldn't get rid of an investment just because it went down in value. That will leave you with a portfolio of nothing but energy stock this year. However, if you have investments that you've been meaning to get rid of for a while, now is a wonderful time to do it. The entire market has dropped meaningfully. You can get out of your bad positions and move into others that are more beneficial to you over the long term at a price that is likely 15 or 30% the discount from what it was trading at earlier this year. Don't chase past performance. Now is a good reminder to stay away from the hot strategy du jour. Every time the market plummets, there's always some investment or portfolio manager that did phenomenally well. Unfortunately, it's impossible to know beforehand which strategy or manager this will be. Sadly, this will not stop aggressive salespeople from trying to capitalize on the short-term success, touting great returns, and encouraging investors to invest in yesterday's winners. Anecdotally, every year, and especially this one, my clients call me to let me know that someone is soliciting them, trying to push products that did well in this environment. Don't fall prey to these charlatans who are selling legacy performance numbers while knowing they can't repeat that performance. Keep in mind, the markets move in cycles. One year's lucky winners are oftentimes the losers the following years. Stick with the proper asset allocation and plain vanilla investments that will allow you to achieve your goals over the long term. Chasing attractive past performance will not work out in the long run. You should consider adding cash that's been sitting on the sidelines. Some investors have the challenge of having way too much cash sitting on the sidelines. In some cases, they may have been waiting for years for the optimal opportunity to invest in the market. There are funds that have not been needed and tend to represent a meaningful portion of their overall assets. I can't tell you how often I get calls from nervous investors who have been sitting on cash for years, but are just too nervous to pull the trigger. If you're a long-term investor, then now may be a wonderful opportunity to invest this excess cash. The market is trading at more than a 20% discount from just a few months ago. Consider this your reminder to add that cash to your portfolio. Required minimum distributions, or RMDs. Here's a reminder that RMDs apply to folks who are 72 and over, and may also apply to those who will have a beneficiary IRA. Well, this is not rocket science. I'm always blown away at how many people come to me after year end telling me that their advisor didn't remind them to take out their RMD. For a trusted advisor to simply ask about RMDs is a great way to avoid a frustrating situation later. Keep in mind, if you're subject to RMDs and don't take them out, there will be a penalty, so be sure to do so. Charitable giving. When it comes to giving charity, there are a myriad of creative options this year, so let's explore just a few. The first one is a qualified charitable distribution, or QCDs. Individuals who are 70 and a half or older can donate all or a portion of their RMD directly to charity. They're limited to $100,000 maximum annually per taxpayer and allow the investor to avoid paying tax on this distribution. Regardless of the amount of your RMD for the year, you can still give up to $100,000 to charities from your IRA as QCDs. You can donate appreciated stocks. While investors have experienced a big decline in portfolio values this year, many folks still have long held concentrated stock positions with large unrealized capital gains. This may be through gifts, accumulating shares from working in a company for many years, or the appreciation over decades of a long held position. Donating these highly appreciated securities directly to charity helps avoid paying capital gains tax that you would otherwise need to pay when selling the security. It also allows you to trim a large position, which helps de-risk your portfolio. You could donate cash proceeds from the sale of stocks that are at a loss. This is particularly relevant in a year like 2022, and it's a strategy where investors benefit from recognizing a loss by selling stock that went down in value. The loss can be used to offset any capital gains for the year, or be used to offset up to $3,000 of your ordinary income. This is in addition to the charitable deduction you will receive for your cash donation from the proceeds of the sale. You could utilize a donor advised fund or a DAF. A DAF is an account where you could deposit assets for donation to charity over time. The donor gets an immediate tax deduction when making the contribution to the DAF. They can still control how the funds are invested and distributed to charity. A DAF can be extremely useful if you hold a security with no cost basis, a highly appreciated stock, or a long time held concentrated position. In all these scenarios, the tax liability can be circumvented by moving that position to a DAF. A DAF may be particularly useful when bunching your charitable contributions, which involves donating several years' worth of charitable contributions all at once, which is sometimes done for tax planning purposes. For example, charitable contributions are only tax deductible to those who itemize their deductions. This year, the standard deduction is $12,950 for single filers and $25,900 for joint filers. To help your itemized deductions exceed the standard deduction amount, consider bunching multiple years' worth of charitable donations. This will allow the donor to exceed the standard deduction this year and take the itemized deduction, yet still offer the flexibility to distribute the funds over the current and subsequent years. Roth IRA conversions are very popular now. A Roth IRA conversion is the process of transferring retirement funds from a traditional IRA, SEP, or 401k into a Roth account. Since traditional IRA is tax deferred, while Roth is tax exempt, the deferred income taxes due will need to be paid on the converted funds at the time of the conversion, and there's no early withdrawal penalty for this strategy. A Roth conversion may make sense if the saver believes that the postponed tax liability in the traditional account will be more onerous as retirement approaches. In that case, it may be better to pay those taxes now rather than later. 2022 in particular may be optimal for Roth IRA conversions given the market drop, which would cause the tax burden to potentially be less than years when the market went up in value. And it's important to note that if paying the tax bill now is too burdensome, then this may not be a good option for you despite all the buzz on this opportunity. The key is to evaluate your personal tax situation and see what makes the most sense for you. Beneficiary updates. Retirement accounts and insurance policies have beneficiary designations so that pass outside of one's will. So even if you did estate planning with a competent attorney, it's important to review various beneficiary designations to ensure that your money is passing according to your wishes. One planning tip to keep in mind: it is not uncommon for couples who have been divorced for years to not update their beneficiary designations. We have all heard the horror stories. It's worth taking the time to review that all beneficiaries are correct. Failing to do so can be a 6 or 7-figure mistake that likely cannot be fixed. Estate planning considerations. If a family member passed away this year, you may want to reach out to your estate planning attorney to review and update your planning documents such as a will, power of attorney, healthcare proxy, etc. That's just a friendly reminder that too few people actually act on. Another planning tip that comes up often in my practice: if a client updated their estate plan and now have a trust, please make sure that their investment accounts reflect their estate plan. One of the most common estate planning client errors I notice is spending time and money to have estate planning documents drafted and then never updating the title on their assets and never actually funding the trusts that were set up. Every year, a new client will come to me and seem totally perplexed that they actually need to move their assets into the trust in order to be effective. It's worth checking that this one has been done so the client's planning has not been done in vain. There's 529 contributions. A 529 is a tax advantage college savings account. They may provide an opportunity for immediate tax savings. Most states require you to invest in the in-state plan to receive the deduction for your contribution, though there are several states that are considered tax parity states, meaning you can use any state's 529 plan to receive the deduction. Be sure to keep in mind the annual gift exclusion for this year. You can give up to $16,000 a year tax-free per person. The annual exclusion recycles on January 1st, so if you don't use your 2022 gift allowance by then, you'll lose it. I believe it's going up next year to $17,000. One strategy I've seen clients use is super funding their 529 accounts. In that strategy, you can spread tax-free gift to a 529 account over 5 years for gift tax purposes. So a married couple not making any other gifts to the beneficiary during the 5-year period can contribute up to $160,000 to a 529 plan for each child this year, and with the proper election, not run into any gift tax problems. There's tax loss harvesting, which is an extremely popular strategy this year. In this situation, an investor sells some investments at a loss to offset portfolio gains that were realized by selling stocks at a profit. This allows investors to mitigate the current tax implications caused by selling appreciated stocks, and it also can help offset future taxes up to $3,000 a year in ordinary income. Be sure to be mindful of the wash sale rule. The wash sale rule prohibits selling an investment for a loss and replacing it with the same or a substantially identical investment 30 days before or after the sale. If you do have a wash sale rule, the IRS will not allow you to write off the investment loss, which can make your taxes this year higher than you had hoped. One point I do want to emphasize is that it's a poor decision to let the tax tail wave the investment dog. Never sell an investment solely for tax reasons. There must be an investment thesis behind the sale as well. There's an opportunity for gifting for estate planning purposes that shouldn't be overlooked. For ultra high net worth families, it's worth considering making gifts today at depressed prices. It's an opportunity to freeze those assets at lower values, using up less of the federal lifetime gift tax exemption to more tax efficiently shift funds out of your estate. The exemption is currently $12.06 million per person. So a married couple with an estate above $24.12 million may be hit with a federal estate tax. Gifting funds to family members or into properly structured trusts will help minimize the tax your estate will need to pay at your death. It's also worth noting that the federal lifetime gift tax exemption is scheduled to sunset at the end of 2025 to approximately $6.4 million per person. Employer retirement plan. It's important to assess contributions made this year by reviewing how much money you contribute to your employer retirement plan in 2022. If you're financially able to do so, it's worthwhile to max out your 401k or 403b. This year, those limits are $20,500 before any company match, or $27,000 if you're 50 or older. It's also worth being mindful of next year's contribution limits and planning accordingly. For 2023, the contribution limit increases to $22,500. Catch-up contributions will also increase to $7,500 so those 50 and over can put away up to $30,000 annually. Be sure to make the required tweaks within your plan to ensure you're making the maximum contribution and making the most of your plan. You should also reassess whether it makes sense to utilize a Roth versus traditional option. The best option actually may change for an investor 1 year to the next based on their tax situation. Should review your investment lineup and portfolio. Should determine with your advisor if it makes sense to make any changes. This is especially applicable if your firm recently switched their 401k providers. If you are in charge of your firm's 401k plan, make sure you're doing plan reviews annually. Fees have come across the industry have come down and investment options have improved. Also, as a plan sponsor, providing employee education is a fiduciary obligation that you should be sure to provide your employees. Don't settle for a subpar, more expensive plan, and you can feel free to reach out directly to me if you'd be interested in a review of your plan or if you have any questions. Another thing to keep in mind is whether you have old retirement accounts scattered at various previous employers. If appropriate, now may be a great time to consolidate them into a traditional or Roth IRA. to keep your assets organized. This is helpful in ensuring that you have a cohesive investment and financial strategy going into retirement. It will also help your heirs upon your death so they don't have to go around searching for your various old retirement accounts. And finally, retirees should reevaluate their safe withdrawal rate. It's always essential for investors to assess their expenses and plan ahead for the future. Given the challenging economic backdrop, this is even more important today than in previous years. It's also particularly important to retirees who may be living on a fixed monthly budget. A retiree's safe withdrawal rate is how much they can spend from their portfolio and not outlive their funds. Make sure to take this opportunity before year end to figure out your cash flow situation and safe withdrawal rate for the coming year. And I want to leave you with just two final thoughts. The first is it's important to set a time to speak with your trusted advisors before year end to work through the various items discussed here today, as well as discuss any other issues that are on your mind. If you're a practitioner, then try to set up a time to meet with your clients before the end of the year. Simply going through this review process will help prepare your clients financially for the coming year and help them navigate this challenging economic environment. And second, many people have reached out to me asking when the market will rebound. The correct answer to this question is no one knows, but eventually it will. As I mentioned multiple times already, but it's worth bringing up yet again, the market goes through cycles, and this time is no different. For those investors with a disciplined process and prudent strategy and the ability to stick with it, you'll ultimately reap the financial rewards once the market and economic turmoil passes and the market does rebound. And that concludes today's program. Should you have any follow-up questions, you can reach out to me directly at jonathan@shenkmanwealth.com. And email is generally the best way to get a hold of me. Three more quick items before I let you go. First, my fall webinar series continues on Thursday, November 3rd, featuring Boaz Feinberg, partner and head of tax at Tadmor Levy based in Tel Aviv, Israel. His topic is retiring in Israel, tax and estate planning considerations. And I'll send out an invitation to this and all of my upcoming webinars after the program. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And finally, if you or a colleague would like to be kept abreast of my latest articles, webinars, or all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. And you could also follow me on Twitter, YouTube, or Instagram. My handle is @ShenkmanOnMoney. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.